All right, good afternoon, everyone. Welcome to our webinar today about the 2021 Housing and Interest Rate Outlook. My name is Jessica Sims. I am our event manager here at Compass Mortgage, and I am joined with John and Caleb of the Kambs Jennings group. So they're going to take you through today what our 2021 outlook is going to look like in the mortgage and housing areas. And from there, we will take any questions that you may have. We can cover those at the end of the webinar, but feel free to send those through the chat box as we go through the presentation today. So without further ado, Caleb.
Hey, so hello everyone. Thanks for joining us today. I wanted to welcome you to our webinar, and basically John and I every first Tuesday of the month are going to be doing a webinar that can help you in your profession with some mortgage expertise. So we're going to be doing Tuesday tips, first Tuesday of the month. We're the Kambs Jennings group of Compass Mortgage. We're an independent mortgage bank. We underwrite our loans, we fund our loans. We have a really strong team. So if you ever need help with a mortgage, we're here for you. And I also know John Kambs is our team lead. He's been doing mortgages since 2003. So he's seen the good, the bad, the ugly. He's seen it all. He's going to walk us through the presentation today. I also want to just let you know that we have an amazing product, that we have this program where we underwrite a full loan commitment that's good as cash offer, that when John touches on how the low inventory, I think this is something that's going to help you win this year. So ask us about that product later. Without further ado, I'm going to turn it over to John to walk you through. So John, take it away.
Hey everybody, how you doing? Thank you guys so much for coming. And this is a little belated, but there was actually, we delayed this a little bit to go back to the drawing board because of some of the changes that took place regarding the Senate elections in Georgia that made us rethink things a little bit. But this is our 2020 housing and interest rate outlook. And let's go ahead and get started. Well, she's back. And who are we talking about here? So Janet Yellen. So Janet Yellen is now the new Treasury Secretary. And a lot of people said that she might not have been the greatest Fed chair. So let's go ahead and give her a shot at being the Treasury Secretary. The one thing that is kind of interesting here is that you're going to start to see her name on all the money that is printed. So the Treasury Secretary signature is on all the money that's printed. And what's interesting about this is that Janet Yellen, she never met a spending program that she didn't like. And she's very different from the outgoing Treasury Secretary, Steven Mnuchin. So Steven Mnuchin butted heads with the current Fed chair, Jerome Powell, often. And the reason why is because Jerome Powell really believes that the Fed should be involved in everything. And up to the point where the Fed was actually buying bonds like McDonald's and Apple. And, a lot of people question this and say, is this really necessary? Do you think Apple and McDonald's really need government help? Well, Jerome Powell seems to think so. And Steven Mnuchin would say no. But what the consensus is that with Janet Yellen, everything's going to be not only green lighted, but she's going to egg him on saying he's not doing enough. So who knows what's going to happen? But there's a direct correlation to her appointment to the rise in silver, gold, and the enormous Bitcoin rise in prices. So is this overbaked? Perhaps, but the overall consensus is that she's going to debase our currency, which could make inflation rise, along with the increase in spending because of the blue wave. And what happens is that gold and silver and Bitcoin are fixed assets, unlike money, which is fiat based. So the consensus is that she could debase our currency, which could raise inflation, which could provide upward pressure on interest rates. So the Fed's going to remain at zero, and the Fed is basically committed to not raising rates, and they said maybe in 2023. However, the Fed funds rate and mortgage rates are not necessarily don't move in the exact same fashion. And what you can see here is that this is a 40-year period, and they move in a similar fashion. The blue is the mortgage interest rates and the red is the Fed's funds rate. But clients don't have a 40-year period to lock a loan. So clients get typically 30 to 45 days to lock a loan. And as you can see, there are many times when the Fed has lowered rates and mortgage rates have gone up and vice versa. If you take a look at the last time the Fed was at or near zero, which is pretty much right here from 09 to 16 for about a 7-year period. And if you look here, there's been some multiple instances where this 4-month period, the interest rates went from 4% to 5 1/8, or this other period where interest rates went from 3.5 to 4.75. So when clients that are on the fence say that interest rates are going to remain low, the Fed said that they're not going to raise interest rates. Well, you can show them this and show them that it's not necessarily true. And moves like this can really affect people's buying power. Interest rates going a full over a point higher can really lower their buying power for what they're trying to do. We don't see this happening, but you can't rule it out, and clients need to know that rates can move up even when the Fed is in fact at zero. So as debt increases, interest rates decline. So a lot of people will tell you that we're incurring a lot of debt, and that with us incurring a lot of debt and quote printing money, which technically we don't do. What we do is we issue debt via treasuries. So a lot of people though will say that since we're incurring a lot of debt, that they see that the interest rates and inflation is going to go up. But in actuality, as debt increases, interest rates decline, and we've seen this and you'll see this in these short-term stimulus plans that have been announced. But what happens is the debt tends to wear off, and a good example of this is that when we incur debt and we do a stimulus program, a good metaphor is when a family buys a car. So when a family buying a car, the dealership gets paid, the salesperson gets paid, the manufacturer gets paid. But after the family buys the car, now they have to pay the debt back, and they have a big payment that they got to pay for 5 years. So after that initial stimulus period, the debt will remain. And as the debt remains, what is going to happen is it's going to hold inflation in check, and it's going to keep interest rates low. After the initial spurt to the economy, the debt lasts, okay? And what'll happen is that the interest rates will trickle down. And this has happened in other countries. The same thing happened in France, the same thing happened in Japan, the same thing happened in Italy, in the UK. As the debt has gone up, the interest rates have come down. So as we see these stimulus packages go into effect, and we actually see, after this initial spurt happens, we see interest rates trickling down. So rates will remain low, but inflation pressure will be lowered. And what's going to happen is you're going to see, like we just showed you, as we incur more debt, we're going to see rates start to trickle down. And then technology, we believe, is going to also hold inflation in check. I mean, look at the fact that we're on a webinar now. As we innovate more, prices are going to continue to stay low, just general inflation. And then the other thing to keep in mind is that right now we currently have 10 million people that are unemployed that are hopefully going to be coming back to alleviate the supply chain. So what we think is just general inflation will be held in check with the amount of debt we're taking on, and as we continue to innovate. And then as the labor force continues to come back into the market, it should continue to keep inflation in check. And the additional spending from the new administration will increase the supply of treasuries to be sold. But again, this is going to basically continue to increase our debt, which will hopefully keep interest rates low over the long term. So what we see though is that rates will be likely to bump higher before resuming a downward trend. And if you actually look at the last 3 weeks, this is pretty much been what's happened. So rates did come up a little bit since the inauguration, and they're starting to come back down again. But there was a little bump higher. But again, overall, we see the interest rates remaining very favorable. Now, housing. What about housing? What's that going to look like? So, some things that I think is going to be very important for you to share with your clients is this. So, what this shows is the births of the underlying each generation, and the average median price or average median age to buy a home now is 33 years old. And if you look here, this is basically the 33-year-olds right here. So in the next 3 years, we have explosive growth coming to the market, and explosive growth in the form of first-time home buyers coming to the market. So you're going to see demand continue to increase. And if you look, the population doesn't really go down from this stage. Here's where, you know, my generation, there was a decrease in births, but the first-time homebuyer births is in these next 3 years is going to be really help to propel demand. Great. So the other thing that we all know is that there's less inventory, and not only was inventory tight before COVID-19, the COVID-19 shutdown really made supply and inventory even lighter. So it was already tight before the COVID shutdown, but this made it worse. And as you can see, look at the amount of less inventory since these builders stopped building and listing because of the COVID shutdown. Another thing that's going to continue to support the housing market is that low vacancies support prices. So vacancies right now are near record lows, and when vacancies are present, the sellers are more motivated. They still have carrying costs. The house is vacant, so they're more motivated to sell the home, drop the price, and get rid of it. But with vacancies being at an all-time low, there really is no incentive for sellers to lower the price. So with these low vacancies, we really see supporting the housing market and supporting the overall prices. And here's another graph of the record low inventory. So inventories are dramatically lower than any other time, any period of time we've ever seen. So inventories are actually the lowest they've ever been in history. So when people say that we're in a housing bubble, if you look at the last housing bubble we had, this is in 07. This is where we are now, okay? So in 07 and then in the 80s, inventory there was way more inventory to have this bubble burst, if you will. And not only is inventory the lowest it's ever been in history, our population has grown since then. So we think that this is going to continue to make demand high and supply low, which ultimately is going to raise prices and have housing perform very well. So the $1 million question, is it a good time to buy? And the answer is yes. And the reason why is that interest rates were going to remain very favorable. There may be little bumps in the road where they go up, but in the overall general picture, interest rates are going to remain very favorable. And then the high demand and tight supply actually points to a 6% appreciation in 2021. And remember, if a client puts down 10% on a home and there's a 6% appreciation, that client actually receives a 60% return on investment in their down payment. So it's a great time to buy, and hope you like this presentation. Let us know if we can get you all these slides. Just shoot us an email. We'll go ahead and open up the floor for questions, and thank you guys so much for coming.
Okay, thanks so much, John. Oh, Caleb, go ahead. Sorry.
Well, no, while Jessica, while we're waiting for any questions, I just want to emphasize too on this low inventory that we're getting ready for the spring market, and we know from our experience that our clients get into multi-offer bid scenarios, and we do have this program that we call our Get Committed program, where we do a full loan underwrite and issue a loan commitment to our buyer, that where we at Compass Mortgage guarantee the funding. And what that does is, if you're in a head-to-head or multiple offer situation, you let us know that you're submitting the offer. We also give you not a pre-approval, but a certificate of guarantee of funding. And John or myself will call that listing agent and let them know that what they're holding in their hand is guaranteed funding. It's not a pre-approval, it's not a pre-qualification. And what we're finding, and we win these bids doing this. So I want to emphasize that. That's how we're going to win this spring. So Jessica, do we have any questions or anything coming in?
Yeah, so going back a little bit to interest rates, the Fed remaining at 0%, do you think or foresee interest rates rising significantly, as was once depicted in the past on one of the graphs that you showed?
We don't see, who knows, is the best answer to that question. We don't see that type of dramatic shift as we did in the past. Those were some pretty, I went through that time, and those were some pretty crazy times, but I don't see that happening. But the point really is that the Fed and mortgage interest rates are interdependent, or they're not. The mortgage-backed securities have a secondary market behind it that is a true market, where the Fed can choose to raise or lower interest rates. So I don't see big spikes like that coming. But if you look at the last 3 weeks, prior to the last 3 weeks, interest rates probably went up about 1/4 of a point. So I think you will see fluctuations for 1/4 of a point to 1/2 a point, which for some clients is a big deal. So I don't see that, a full 1.25 happening, but again, we can't rule it out, and clients need to know that by the time something like that happens, you don't get to go back. And it happens pretty instantaneously. It's not like we get, hey, rates are going to go up a full 1.25 in the next couple of weeks, hurry up and make your decision. It tends to be, bam, rates are up. So there's a saying that rates go up fast and down slow. And in my career, I've seen it happen. So I don't think you're going to see dramatic shift like that. But again, we can't rule it out. So.
Okay. Caleb, you were mentioning the Get Committed program. Could you detail a little bit more how that differs from a pre-approval and how you're able to guarantee funding?
Yeah, so basically right now, when you refer us your client, what we do is we do a pre-approval consultation where we pull their credit, we get documentation, and we verify that as a loan officer and issue them a pre-approval. When we do our Get Committed program, we do it one step further. So instead of just we'll still issue a pre-approval if they need it right now, but then we turn that file over to a real life human underwriter, who will then start the process of a full underwrite. And and it's on a to be determined on the property. So it could be $400,000 purchase price, to be determined on the property. We submit it to the underwriter. So it goes through the full underwriting process, where our client is now fully underwritten, and Compass Mortgage then issues a loan commitment guaranteeing the funding. Our only contingency would be appraisal. So now basically the contingency now is on the property, not on our buyer. And what we find in that situation, if you're going head to head or in multiples, that once the listing agent and the seller understands what's in their hands with this loan commitment, we win those all the time.
That's good to hear. Let's see, you had just mentioned appraisals. What does timing look like on that right now for you guys?
On appraisals?
Yes.
It just depends on where we're at in the market. I mean, appraisal turn times, so typically are taking a couple weeks. It's been, definitely with folks are busy. So different markets are quicker than others. So it would depend on what market you're in, but I would say 2 weeks.
Okay. Let's see, back to Get Committed. Is there a certain amount of time that the loan commitment lasts, and how does it work when you do need to submit the property or property address to you?
Yeah, the commitment's good for 120 days, but we're going to have to, I mean, ultimately what happens is we will have to do some update of documents. Like we'll need the most recent 30 days pay stubs. Basically, it's as good as their credit report is. So we may just some minor updates, but it's definitely something where if someone's going to buy in the spring, now's a good time to start getting them into that process.
Okay. Let's see, another get committed loan commitment question. How long does it take to get the full underwrite?
That can take up a couple weeks. It just depends. It always depends on how fast the client, as you all know, moves with us, right? If we have all their documents, everything we need, and we submit it, it can be done in about, I would say, 2 weeks to get the full loan commitment.
Okay. And are you guys seeing any other solutions in your realm to combat the low inventory? And what does new construction look like from your vantage point?
So I'll answer one part of that question. I don't have the answer on the new construction stuff, but I'll say on to us, how to win is just having a conversation with your client, asking them, do they really want to win this offer? And what we find is that if you have a get committed offer where we're guaranteeing the funding, and then if your client's willing to offer 10,000 above listing, again, let's say it's a $300,000 property, they're willing to offer 10,000 above listing with the guaranteed funding, we're finding that that's the secret sauce to win. And then we can do the math for your client to show what's the difference between a $10,000 more in a purchase or not. Is it worth paying $30 more a month for your dream home? And often our clients are saying, yes, I'll make an offer a little bit above listing to do that. So on the new construction, what was the question about new construction?
Sorry, you might be hearing my dog in the background. Combating low inventory. It was kind of a twofold question in terms of, are you seeing any other solutions from your vantage point, including new construction, to combat that low inventory that we're all seeing?
Yeah, I mean, I think that one thing is that we traditionally have done renovation loans, and those have been put on hold for the moment as a result of COVID. We're hoping they will come back, because that definitely can be a solution towards the low inventory. If your client can see past, they can see a home that has the bones that they want, but maybe they're going to go ahead and do a renovation. But otherwise, right now, I mean, really, that we're all struggling with it. I think our job as a lender is just to try to put our client in the best position to win when they make that offer.
Sure.
Yeah, and I think
go ahead, John.
Sorry, I think with the COVID-19 shutdown, like you saw, you're starting to see, as the vaccine comes out, you're starting to see things pick up. And there was actually another Fed person came out just today and said that he thinks the economy is going to be a lot better, get a lot better, a lot faster than everybody anticipates. So I think you're going to start to see more and more new construction pop up, which should hopefully help inventory. But a lot of times, be careful what you wish for, because a lot of times new construction can, I'm sure you guys have seen, they can kind of try to butt out any new realtors or even lenders. They'll have their own in-house lender. They won't. I know Lennar, I was reading, is a home builder that basically always tries to cut out the buyer's agent. So I think you are going to see new construction continue. It's a pretty. We see a lot of people. I've been getting a lot of questions as, do we do lot loans? And it's kind of, people are throwing their hands up in the air saying, forget it, I'll just build the house myself. So I think you're going to continue to see that. But for the moment, we're still in just barely past the post shutdown, where I don't think builders are really up, and depending on your local market, but here in Chicago, we're in the middle of winter on top of it. So I think that when you get into next year and you see as we approach herd immunity, you're going to start to see new construction really start to pick up.
Another question here, what is the % down required for the Get Committed program?
It's just like we can do it whether conventional or FHA, and conventional you can go as low as 3% down. FHA is 3.5% down.
Yeah, or even VA, we could do 0%, but we could do it on all any of our products. We can do the Get Committed program on. Jumbo can be a little tricky, but call us if you have a jumbo loan that is looking to do something like that.
Okay, cool. That looks like that answers all of our questions here for today, you guys. So thank you so much.
Awesome. Yeah, I just want to say thank you for joining us. If you have any questions, we are 100% referral based. So we are here for your pre-approvals. And also if you have clients who may need to refinance right now, rates are at historic lows. Buying power is as great as it's ever been. And selling, and as you know, selling power is as great as it's been. So if you got folks, have them sell their house, buy a new one. Their buying power is better than ever. So we'd be glad to help. Anything else to add, John?
No, John, I would just say thank you so much for coming. And then, as I mentioned, let us know if you want a copy of this presentation. I know some of the slides here I used multiple times when I'm presenting to clients that ask me about where I think the housing market's going. So we'd be happy to provide them to you. Just shoot us an email, give us a call, text, and we'll get you the presentation.